Well, hello everybody, and welcome to my video. Yes, I finally managed to record this video and get into it after much preparation of the material that I'm going to be talking about. Um, this is the first video that I've done so far regarding some forex educational material. So I'm sorry, if it looks a bit amateur at the beginning. I will probably get better and better with time later on. But to get started, yes, I put together some information. We're going to go through all of these together, and then I'm going to show you flipping between the slides to the charts, and then we're going to talk about some indicators and some stuff that we traders need to know. Just before we get started, yes, it's me. I'm Solid Snake. I have been trading for over 7 years now within the forex market. Yeah, I make a sort of a living out of it. I could make a comfortable living out of it. It's not been easy to get here, and my aim is, together now with a new project with candlesticktrade.com, is to get more traders and more people involved in trading and help out doing it for free. So yeah, get on board. I'm going to put some links later of where have I found all of this material and where you can find more help. But shall we get started, and then we'll obviously revisit all of that later. So we couldn't really get started without an agenda, and I have decided to break this video in three parts. Part one, I'm going to be talking about them things you can see there. Part two and part three was going to be the reason for these is because if I put everything in one video, it's going to be huge and it's going to be very heavy, and yeah, you will probably break a few computers up. So I may as well do it that way. So if we get started then with the first one, I have got some notes on my own notes printed out, and I've got it all ready. So if you hear that I'm sort of flipping paper in the background, don't worry. I still here. I'm just trying to obviously follow my notes, make sure that the educational material is as structured as possible for everybody to understand it. And if we get started, yes. Everybody would say that they want to go straight away. Show me how to make the money. Show me how to how can I make some money here with this market. But sorry, guys, I have to start with the principles. We have to start to understanding what the market is and how it works in the background. I'm not going to get very deep into it because you can have a lot more information in the links I'm going to give you later. However, we all need to know the principles. We need to know why the forex market exists, and we have to know where it comes from. We're going to talk about some exchange and exchange rates. So how does that work out? Type of markets, who are the players, type of market analysis, which there are three. We've got technical analysis, and I'm going to talk about some major tools very briefly. We will obviously get into it later anyway. Some fundamental analysis. We're going to see how do we look at fundamentals, and how do we read the news in the market. And then we're going to talk about some sentiment very briefly, really. I mean, we could talk about these things for hours, but we're only going to look at it very briefly, and then you can obviously investigate further. If these later on progress to something more common, I will probably start doing it more often, and do some sort of like weekly reviews, and do some like weekly view of the market. But yeah, we'll get started with these and we'll see how it goes. Part two of the next video is gonna be the about chartism. So yeah, the art of charting. We're gonna look at type of charts, price moving, common chart indicators, patterns. I have dedicated as well a whole section to Elliott theory. I know there is a few of you that would like to hear a bit more about that. So yeah, we'll look at that. We'll flip between that and the charts that we've got available, and then we can see some of that stuff happening. So before we go any further, I do have to show you this disclaimer. This is obviously all advice only, and this video is for general advice. I suggest you to pause the video right now and read these before you decide, you decide to continue watching it. I'm going to put these slide in the 3 videos as well. The reason for these is because we all know, I'm only going to be talking from personal experience, and I'm going to be talking about how do I use these indicators and how do I use these tools that we've got here, which it doesn't really mean that we all do it the same way. And I'm probably going to say things that are not official and probably make some minor mistakes that other traders would probably find offensive. But yeah, it's the way I see the market. This video is only about how I see it. It's not telling you how to trade or telling you to buy or sell. I'm never going to say that, and we should never say that. But yeah, I'm going to show you a little bit of what we look into, and you have to be aware of your own risks, and you have to be willing to accept that in order to invest. So the first advice I give you before we start looking at anything is exactly that. Don't trade with any money. Don't trade with any money that you can't afford to lose. That's the first advice I will give you here today. Yeah, so after you've read that, then we can go through and we can look into some real stuff. Okay, so the principles of the market, very simple. If we don't trying to go in too deep, is pretty simple. Is pretty much the buying and selling of a currency. That's it. That's the forex market. An example of that is in order for you to purchase souvenirs in France, Americans, for example, will need first to change their dollars and buy euros in order to purchase the stuff in France. The principle of the forex market is that you buy a currency if you're going long, if you think that currency is going to evaluate in the future, and then you sell that currency when it's got higher value, and then you make a profit out of that transaction. Short selling is a bit different, but we'll look at that later in a bit more details anyway. But yeah, that's the principle. You not only do that yourself when you go on holiday to France in this occasion, but you only do that yourself. You also have hundreds of thousands of companies and institutions and banks changing money every single day to fulfill trades and fulfill purchases that they do within other countries and other monetary unions. It happens all the time. It's been happening for quite a long time. I think the market, the forex market, if my memory don't fail, it goes back to the 50s and early 40s. So yeah, it's a very common thing to do for institutions and for big companies that will need to purchase assets in different countries or need to pay their employees in different countries. They have to use the forex exchange. So any transaction that occurs in the balance of payment needs a foreign exchange, of course, because you need to pay with different currency, so you need a foreign exchange rate. This rate is determined in the foreign currency market, which is the market that we are on. So yeah, but simply put, the exchange rate is the price of a currency, and this is always measured against another currency. You can measure major currencies against other major currencies, and then get an average of that, which are called the indexes. But no one, I mean, only macroeconomic indicators use that sort of information. You will be doing, you will be buying and selling currency always against another currency, because otherwise you don't know what the value of what you're selling is. So, in a very blunt example, if you have euros and you think that the dollar is coming up in value against the euro, then you would obviously buy dollars with your euros, and you at the same time that you do that transaction, you will be selling your euros as well for dollars, and then you will keep your dollars for a little bit until that appreciates in price, and then you can convert it back to euros later, and you end up with more euros than we had before. That's very simply the forex market on a very speculative way. That's how speculators work with the market. As I said before, institutions, they exchange money in order to make macroeconomic payments and things like that. And companies exchange all the time when they import and export. They have to pay their goods in a different currency. It's a very clear case of Japan. Japan likes the yen to be very cheap because it's an exporting country, and they want to export everything. So what they do is they keep the value of their currency really low, so that everybody can afford to pay that currency. It's as basic as that. Um, so yeah, let's talk about the next one then. So it changes in the exchange rates. Changes in exchange rates. So realistically, the exchange rates, the function really shows the supply and demand of certain currency. So even though nowadays there are a lot of other different indicators, because speculators are getting bigger and bigger in the market, which really takes away that sense of supply and demand. When speculators enter the markets and they're allowed to play with the exchange rates and buy and sell freely, then you sort of lose that supply and demand rule for the currency, because it becomes abstract, it becomes more technical when speculators are trying to buy and sell just to make money. But the basics of exchange rates, it should be supply and demand. So obviously an increase in the supply of a currency will decrease the exchange rate, the price of that currency, and subsequently a decrease in supply of that currency will increase the price. An increase of demand of that currency will increase the exchange rate, and a decrease of demand will obviously decrease the price, the exchange rate of that currency. So those were the first rules in the market, in every single market really, based or on supply and demand. The more supply there is out there, then the cheaper that becomes. And the more demand, the more that people need that currency, the higher in value becomes, because there is less available. So yeah, those are the main principles of the market. I chose these explanations because it's really basic, and it's sort of for people who's just starting, they get a very good grip of later on when we start talking about support, resistance, and levels and things like that. Then you always have to think about supply and demand, and where there is a lot of injection of supply of that currency, then you see the other currency obviously increase in value and all of that. So yeah, that for now. We'll leave it there, and then we'll come back to it later anyway, when we're explaining other things, and you'll hear more about these later. You hear supply and demand all the time. You also hear when you're watching TV, or when you're watching Bloomberg, CNN, or any sort of economic programs or people talking about it, you hear a lot of the supply and demand levels, where certain currency has been demanded more, and obviously the price will obviously increase. There we go. So type of markets, and yeah, you will probably recognize these two diagrams here anyway. But yeah, it's just to show you the sort of market that we have. We obviously have two type of markets, and we are now in sort of like um, these sort of markets. Um, that didn't work very well. That's better. So yeah, I mean, these type of markets up here is a centralized market. And it's very typical in the stock markets, and where you have sellers, you have buyers, and then you have the master of the universe, where you have the regulators, the controllers, which is obviously the stock entity that controls the stock that day, who controls the price and controls the spread, controls the difference between bid and ask prices, and he sort of put things right for the traders and for the buyers and sellers in that market. We, unfortunately, and I say unfortunately for reasons that you'll understand later, we work on a decentralized market. So um, in this market, there is no official entity that controls the price. There is no one unique price, and there is no specific price for a demand and a supply. So bid and ask for certain currency for the asset that you're buying and selling. But so in exchange to that, we have a networks of desks where currency is bought and sold all the time. And these networks, they through an interbank um, electronic system, they talk to each other, and they show you the price wherever the price is at a certain time. So you can see how messy it becomes. You have banks there in between certain, in this case, a routers machine, which is routers network, and they all buy and sell from them. You have the ECN brokers that they also participate with interbanks, and then you have the market makers, which is they're all of our brokers, all of the brokers that you will be using to deposit your money and trade through. Unless you have a lot of money, then we have access to the market through them. But then they only contact banks, and they only contact some of them. They only contact all the ECM brokers. So you never actually get access to the direct feed to the network straight away. You have to go through a few intermediaries. And yes, as you think, this is like everything. You get intermediaries. They all charge you. They all cost money, and they manage to fix certain commissions, and they call it spreads. So every time that you open a position, instead of them charging you a monthly commission or a monthly fee for your account to be open, to put it a bit easy, they charge you this spread, which is the difference between the purchasing and the selling price at certain points. Some brokers are 2 pips, 2 basic points. Some other brokers they charge you more than that, depending on the assets. So, and some obviously less. But in a very nutshell, that's what they get, and that's what every single intermediary in the bank gets. Obviously, the better connection that you have with the direct network, the better conditions that you get to trading. This is like everything. This is like you selling in a car boat sale. The better conditions that you get, the better the more money that you pay for your space, and the less taxes and the less intermediaries you have to pay. This is like everything, really. So, but yeah, what I want you to get out of these slide is you have a centralized market, which is the stocks and all the probably all the ECFs and all the instruments, the banking instruments, and then you have the forex exchange type of market, which is a completely decentralized market. It works on an interbank network, um, and for obvious reasons, prices are difficult to gather with accuracy because certain desks have different prices. I'm only talking about difference of probably 1 or 2 pips, 1 or 2 basic points. But if you try with high frequency or something like that, that could be a lot of money in one of them slippage. So yes, that's the downside of the forex market. Also, find out volumes of negotiations at certain times is I would say, unless you have a very direct feed and and you have a really good platform, it is very difficult to find. I would say near impossible to actually get what is the volume traded, the volume negotiated at a certain time of the day, in total of the market, because we're talking trillions of currency going up and down. So yeah, that's one of the downsides of the forex market. The good side though is that you have easy access, and you don't need to go through a very painful process of accreditation, and because obviously this one here would is a very strict regulator, and you're sort of less exposed to manipulation of the prices because there is so much choice. Um, and also there is a lot of competition between these guys here, these guys there, and all of these banks. There is a lot of competition to show you the best rates, so they're all compete with each other. When up here there is a master of the universe there, you can't compete with them. They move the price, they control the spread, they do whatever they want, and you have to go with that. So yeah, that's in a nutshell how the difference between our market and other more common, more heard markets out there. So up to the next one. Who are the players? And yes, I know you'll recognize these diagram as well. It comes from Baby Pips. So I used it because it's the simplest one to use, really. So the hierarchy of the forex market. This doesn't mean that you as a trader cannot compete with them. You can if you have a few billions and you trade like that. Yeah, you probably can do it. But sort of to put it in a few steps so you understand where you belong at the moment. Now starting with your 100 quid account, where you belong is unfortunately down here. That doesn't mean that you can make that you do not we're able to make benefits. It doesn't mean anything really if you use it correctly. So major banks are the top. We say in major banks, obviously the big guys, the big players, they do invest a lot, and they use the market in 2 different ways. They use the market for their own operational transactions and for their customers' operational transactions, and they also are speculators in the market. They do, but I mean, all of the major banks, they all have their own divisions of futures and currency traders and investment traders and pension traders as well. So they all have a play as well in a speculative way in this market. Then you have the electronic brokering systems, the big networks that we said before. EBS is a very competitive one. Reuters and Bloomberg used to sort of own the monopoly in the market, and then EBS was introduced in the European community to make a little bit of to make it a bit more competitive and sort of create another interbanking system. But they're pretty much all the same. They do huge operations in the market as well. on behalf of their clients. And I mean, their clients could be your broker. So they put a lot of money into the market and also take out a lot of money into from the market. So yeah, they're the big players. Then we have the medium size and the small banks. I would also get into that bag, even though they didn't put in that bag. I will also get like big institutions and big companies into that bag, because not all of them, but some of them, like you could say, for example, Microsoft or Google or Apple, they're all have their own currency divisions. They're all within the financial divisions and teams that they've got. They also have their own exchanging. They're not speculative. They don't do that, because that would be a different financial activity within the company structure, and that will probably mean some sort of trouble for them to justify that income. But they do use it for them to exchange money at certain times, and they hold accounts in all the major countries in the world. So they all move money, and the movement of that money also means that the market moves with it, because they're operating as well as medium-sized banks. So I would like for you to to drop that in that bag there, because that's another player there that we didn't have. And then down here we have some hedge funds and commercial companies, sort of medium to large size commercial companies. They also do some transactions. Hedge funds, which is purely speculative, and I mean, hedge funds, they might have a participation in forex, or they might go 100% forex based, and they obviously will have more implication. Then you have the retail ECNs, and then the retail market makers, which is pretty much your brokers, your IG, FX Pro. I don't know, Trading 212 if you want to go for the small one. There are a lot of them out there, so yeah, just to mention a couple. And then it's you down here, me as well, and pretty much all of us retail traders. We are down there. We also have some power to move the market, not as much as the major banks and big institutions, but if we would say to use all of our leverage and all of our capital to move certain currency at a certain time, and we will all be able to synchronize at each other's to do it at the same time, we would probably move the market a little bit. So yeah, we deserve a place there as well. Okay, so up to the next one, and we're starting to get into material here now. I know that at the moment we haven't seen any charts. Apologize about that. We're getting into it. I will tell you about types of market analysis. What is market analysis? I mean, well, it's pretty much analyze the data that is available and will influence that market. That's it. As simple as that is. And we have three legs to do our market analysis. Now, some traders only use one of them. Other traders use two. I use the three of them, and I recommend you to use the three of them. I know there are strategies out there that they claim to be miracle, and you don't need to do anything other than just look at the charts, which is brilliant. If you can do it and you make money with that, happy days. I'm not saying don't do it, but I like to wake up in the morning, put my news on, read my newspaper, look at what's happening in the world around myself, and obviously understand how that influences the exchange rates, and how can I use it to make money. So I like to trade with the three of them, and that's why I've decided to include the three of them in my video. We're going to talk about technical, fundamental, and then sentiment later on, and that's going to be unfortunately the end of the first part of the video. We'll get into chartism later on. So to get started with technical analysis, I'm just going to read you that because I can. Forex charts are based on market action involving price. There are 5 categories in Forex technical analysis theory. There's indicators, loads of them, oscillators, RSIs, hundreds of indicators out there, and every day there's probably 50 or 100 new indicators a day that they get invented, they come out, and they all use mathematical formulas and past prices and different different values within a chart within a certain point in time to show you something. That could be a strength, that could be momentum, it could be a lot of things. Then we have number theories, which is everything that include numbers on it. So we have Fibonacci numbers, Gann numbers. There is a couple more going around, but I didn't really want to put them on. I don't want to make you feel bored, and you're probably already sort of thinking, "What is this guy talking about? I'm going to go to sleep." Then we have the waves and harmonic patterns of the price. And I have actually dedicated later on a whole section to Elliott wave theory. So I want to talk slightly about it now in this part of the video, but later on we will get into it and we'll look exactly how does that looks like and all of that. Gaps, which is actually when the price there is not been trade in the market, there has not been any trade, but the price has moved, so that shows a gap. So we will look at that a little bit later anyway. And then we have trends. So following moving average and how the price is creating a trend, is trending. Is it going up, down? What is it doing? So yeah, just to sort of say, coming back to technical analysis. I mean, let's remember what technical analysis means, and it's a method of predicting price movement and future market trends by studying charts and studying past market actions. It is concerned with what is actually happening in the market rather than what should happen. So you do technical analysis basically with what you can see. That's it. With the stuff that you see in the charts in the market, not with what could happen, or that's a different. That will be more sort of fundamental or sentiment. I mean, one major advantage of these sort of TA is that experienced analysts can follow many markets. Doesn't matter what instrument you do, doesn't matter what you trade, doesn't even matter if you trade Forex. You can follow a lot of different other markets and other instruments, financial instruments, and probably make some money with them as well, if you know how technical analysis works. Because these things are applied to Forex, but they weren't invented specifically for Forex. They're only being adopted to use it at Forex. There is three essential principles of technical analysis. What obviously is market action discounts everything. This means that the actual price is a reflection of everything, and anything that would affect it. For example, supply and demand, political factors, and market sentiment. However, the pure technical analyst is only concerned about the price movement. They don't care about political factors and all that. The second one is price move always in trends. So technical analysts use their tools to identify patterns and market behavior within these trends, and place their trades in between. And the third one, and yes, this is probably the most obvious one. History always repeats itself. We've seen it recently with the euro dollar forming two gaps and recovering from the two gaps, closing the two gaps 2 times in 2 weeks. So it repeats itself. Humans are not very well for creative, very well for creating brand new things. We like to go through what's happened before and do it again and again and again. So yeah, so let's talk about some of the major tools then. Let's go through them. So the relative strength index, this is one of the indicators. This is an indicator there. I mean, to talk a little bit about this one, let's load it up first into one of our charts. And here we go. This is what you wanted to see now for about 20 minutes. Sorry. So let's just load an RSI here, and then we can look at it. Where are you? Relative strength index. Here we go. So what does this do? It measures the ratio of up moves and down moves, and normalize the ratio with a calculation expressed, and then that calculation gets expressed in a range, and the range goes from 0, which is down here somewhere, to 70, or probably greater, you know, if it's a very pushy one. As you can see, if it's a very pushy downwards, it goes before the normalize. I'm just gonna see if we ever passed in the daily chart. We probably have done it on the smaller time frames, but on this one, daily charts we haven't. So I'm going to use daily charts. It's quite steady. Then this instrument is assumed to be overbought when it's above the 70 mark, and it's oversold. The price is oversold when it's below the 30 mark. So as you can see here, for example, the price on a daily chart, the price was very oversold, and that means that it's cheap. So what are you going to do if something is cheap? You're going to go out and buy it. So this is pretty much the same. You're going to go out and buy it. And if we look at how would we use these to make a trade, if we just put here just a quick vertical line there where it's hit at the bottom, oh, that vertical line is a bit small. Let's just make that bigger. There you go. So you can see from there to the top of the, let's just have a little look. Let's just say that's the top. Let's not take it. So there you go. You know, you can see from the bottom to the top, and from the bottom to the top. You will probably have made a good trade there if you use just RSI. There you go. That will be your trade from 105.09 to 113.28. Pretty good trade there if you would have bought at that price and would have left it going until you see the RSI touching the 70 line, and then I get out of there because it's too expensive. So yeah, again, you know, in a nutshell, on a very simplistic view, that works very well. On another view, though, there are situations where that doesn't work, and I'm not sure if I'm going to be able to find one. But well, there you go. Here, for example, you can see we've got that oversold there until the overbought here. Well, not overbought, but just crossing the 50 line down there, and that would be a pretty bad trade. Let's just sign with these. There you go. So you know, you come up here, you say, oh look, you know, he's very oversold, he's very cheap the price. I'm going to buy there, and I'm going to buy expecting these to go up, and that didn't happen. So the price, it did went back to sort of the same level where you are, so you wouldn't have lost much money. You will probably have hit your stop loss somewhere around here. But yes, the price didn't went up. In fact, look, you know what happened later. So yeah, it doesn't work all the time. You need different indicators to sort of make sure that you're in the right path. But yeah, it does work sometimes. You know, you can make good trades with it if you are quick, and if you combine it with other instruments. And this is something that you will start to see more often now. Technical analyses indicators, they never 100% work on their own. You always need to use a series of different indicators to show you, and you will only trade when they're all aligned to tell you something. So when all of them align to say the price is cheap, then you will enter long and you will buy. But if they are contradicting each other, you would probably stay out if you are a technical analyst and you only trade with TA. Okay, so that is the first one of the indicators, and that's how it works. I hope you like it. That's it. See you tomorrow. No, I'm not going to go here. Let's look at the next one, which is a stochastic oscillator. Again, the RSI is an oscillator as well. The stochastic is another sort of oscillator. So let me get rid of this one and let's add a stochastic here. I really like a stochastic. It's a really good indicator, and I do use it sometimes. I do keep it very handy. This is quite a good one. But again, it does exactly the same. It normalizes the price using a mathematical calculation of averages, and it sort of smooths the price up here, or accelerates the price depending of the momentum of that price, depending of the candle volumes and sort of that stuff. So he sort of tells you when things are like the RSI, when things are overbought or when things are oversold, on a scale of 0 to 100%. This indicator is based on two lines with two calculations, the percentage K and the percentage D, which there you go. They're the two lines down there, and they're both used to show you something that's called diverging and convergences. So divergency is when the price goes away from a certain point. Converging is when the price goes together. It's just one of them things. So you will be looking for a few things with this indicator. Again, on a very simplistic nutshell, you will look when the price is overbought and when it's oversold to sell and buy, and you will probably again have got a few good trades like that one again. You look from there to there, and you look in the same time frame from there to there, and yes, hello, it's a great trade. But again, you probably go back here and you find yourself finding the same sort of signals when they're not really real signals in the price up here. So you will be looking for something called divergences and convergences. So you look at for the price to penetrate certain level, and these to be a lot oversold, and then for the second mountain, for the second, or in this case the second valley, to be not as much penetrating on the price, but still getting into the oversold level here. So he's sort of getting away from the level. So a good one that you can find is, and they usually look like two lines, and that they at some point they're going to find each other. And I know this sounds a bit weird at the moment, but let me explain it to you. So this is a very good divergence there. You can see the one bottom here and one bottom there, and these produce a pretty much what we say a 30-degree line pointing up. But in the stochastic, it forms the opposite. It forms a that's not going to allow me. There you go. It forms at the opposite line, and it's not the same degree that one. Otherwise, it would be an amazing divergence, and you would enter for a very long time. But it's sort of you can get here how it works with the divergences. What you will be looking at really once the divergence is being confirmed is for the slower line. So in this case, the orange line to cross down here the blue line, or to cross. I would be, for me as a safe trader, I would be wait for this point here. I would be wait for where the price enters back into our range, which is what we trade. We don't trade over here or down here. We trade where the price penetrates that level, which is in this case is actually is 20.2626, and at the same time is crossing, or it has already crossed the blue line, and they're both pointing up as well. So there you go. That's a good divergence, and then you'll be looking to place your trade there, and you would have made a little bit of money. You would have probably done that here, and well, you know, if you catch up the whole of the trade until the point where he's overbought again, you would have made a few points there. You would make 163 pips, which is not bad really. And your stop loss could have been really small there because of that bottom there. You sort of can be shown. So your ratio, your risk and reward ratio would be quite good for a good trade there. So there you go. That's stochastic. That's how it works. It not only works, you would find all the situations at the back, I guess, where you still finding divergences, and they give you a false entry. But you know, you have to be ready for that. At the end of the day, you've got to be ready for that. Working with money management and risk management and all that. We're going to talk about that in the third video, so keep tuning. So yeah, look, well, just before we go, that's another sort of oh, there you go, another sort of indication of divergences. This is not as much as the other ones, and this is a good one here. So that's pointing up, and this is sort of flat. If they both point up, you obviously look into continuation, but you know, you look at this, he's already getting tired of being up there. He's very tired and he wants to come down, so you wait for that to cross, you wait for the two lines to point down and enter our range, and then you will place your sell order until here. Right, so moving on. I know you guys would probably use these in different ways. I'm sorry about that. You can virtually slap me later if you want, but yeah, I obviously accept your feedback anyway, so let me know how you use it. It will be quite a good conversation to have. Back to our slide, we have the moving average convergence divergence. This is pretty much another oscillator. The MACD is a good one. It's a very common one as well. A lot of people uses this one. Let's just look at it, if I can find it. MACD, here we go. It was about to go far away from me. There you go. So this is a MACD. It looks a bit more confusing. Just to sort of put it in a nutshell, these indicators involve a couple of things. Involve plotting two momentum lines, and momentum is gained by force by how much push a candle has at a certain time. The MACD line is the difference between, so this one in the middle here is the difference between these two, but is normalized, which means that it is in respect to a zero line. So that's got its own scale. This has its own scale. They both work on the same one to sort of show you like an impression of how much power certain trend has a certain time and the direction of it. So these two things here, they're just moving their average. They're just simple MAs. But the trigger line, which is the faster one, the orange one in this case, is sort of more faster than the other ones, and it triggers the signal when it crosses the slower one. And when they both cross the center part, in whatever direction they cross it, then you would open your trade. Yeah, no, this is in a very plain nutshell. There are books and books just about MACD, so go out, buy one, and read it fully. I'm not going to spend much time on this one. But you know, you will be looking for signals when the MACD line crosses, so the trigger line crosses the center area, and they're all pointing up basically. which is, there you go. You can see down here it crossed it, and he's a bit retarded, this one, so it gives you a later entry. They both crosses up, and you would place your buy there, and then you would place your sell when they cross back down again. So yeah, that's in a nutshell. Well, if you look at the price, how it works, boing, 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 you can see these two lines are pretty much a representation of the price, really. It's just a bit more smooth, and you can see on a downtrend, these lines are always staying below the zero line of the MACD line. Yeah, so because that just shows you that you're in a downtrend. When you're above that, you're looking for in my case, I'm a swing trader. I like to trade with the trends. So while this is above, if I only use this one, then while this is above, I will only place buy positions, and when this is below, I will only place sell positions, really. You know, a lot of scalpers use it in a different way, and if we probably go into a 1 hour, then we can probably see how it oscillates a lot more than the other ones. Let me just get this a bit further away. There you go. You know, so yeah, again, when he's over the center line, it will only place buy orders. When he's below, it will only place short sales. You can sort of gather in a very broad view how it works. Okay, so moving on to our next one, number theory. Right, okay, so what's this about number theories and all of that? And when we talk about number theories, we talk about two things. We talk about Fibonacci numbers and Gann numbers, which I'm gonna do them both together. So back to our chart, a daily lovely chart. Fibonacci, it was a guy that found. Well, I mean, I know some people will kill me for this, but yeah, he was basically a guy who found a number sequence, a magic number sequence. And why is it magic? Because he's everywhere. He's in nature, he's in construction, he's in all sort of places. You can probably, if you put Fibonacci number sequence in Google, you will probably find beautiful pictures of leaves and plants with the Fibonacci series, and it's quite interesting. He's basically constructed by adding the first two numbers to arrive to a third number. That's it. You know, that's why the series is actually 1 1 2 3 5 8 13 21 34 and so on. So you get the series like that. Now the ratio of any number to the next larger number is 62%, which is a popular Fibonacci retracement number. The inverse of 62%, which is 38%, is also used as a Fibonacci retracement number. So yes, in trading, we don't use exactly Fibonacci numbers, but we use ratios between the numbers. And that's how we know, well, not we know, but that's how you can find your first target after a massive impulse of a trend. Why? Because it's easy. It's broadly used. Everybody knows about it. Everybody uses it, and it's a very easy thing to do. So why complicate your life? If after a massive push you find a signal or a sign of reversal, then you put your Fibonacci in place. You place your order opposite to the main trend, and you will place your targets within these Fibonacci percentages. Simple. Right, so how does that look in our chart? This is again our daily chart from May 2014 to nowadays. And yes, I know it's a huge time frame, but it's the best way where I can show you Fibonacci for the first time. We're going to look at it in a bit more. I'll probably find a couple more, but let's just do this one first, and you'll see how incredible, how magic Fibonacci is, and how broadly traders uses these. So putting again, we draw these from the swing top to the swing bottom. So that is sort of from whatever trend you're looking at or whatever time frame you're looking at. You're looking for the last ever highest price. I mean, I know we probably go back and we probably have higher than that, but it's you're looking at your trend. If you go back, you would probably will be a different trend. So you're looking at within your trend, within what you're doing at the moment. You're selling here. You're looking within that trend. Where is the swing high, which is the highest ever level, and in this case there is a double top there at that level. I would say a triple there, sort of. At 140, and then you will look at your swing low, which, yeah, it is can be as well at any point where you're at, because obviously when you don't know where the swing low is, then you have no idea where to place this bottom bar here. So how to find the swing level? Well, find a double bottom, find a reversal signal. We're going to look at all of that later anyway. Find something that tells you the price is losing fuel, is losing momentum, it's losing power, and you can find that when there is a higher bounds than it's ever been before. If you look at these bounds here, none of them are bigger than this bound here. So once after that's happened, obviously you would stay out at the moment, or you would choose to start think, if you sold around here or all the way down here, you would start thinking, oh, wait a minute, that bounce is bigger than ever before within my trend, so I'm going to start drawing my Fibonacci down. I'm going to see how far could this go. Now, what are the most common places for traders to look at Fibonacci? And let me use the screen draw. I don't know if it's going to work very well, but I'll give it a go. Here we go. So, okay. So we have the first one is the 23.6, 23.6%. That's sort of the first level, and look, euro dollar is done amazingly there, testing and yeah, just sort of going and trying to break that level there, where big investors that started selling up here, they now picking profits up. Next level, which I personally look for, is 38.2%. And if I give you an example, if I bought back down here and it's done that, I would probably be putting my first target, if I'm looking for the belly for sort of a long trade. I will put my first target here at 23, and my second target here, and that's TP2, and that's TP1. I wait for the price to come all the way to me, and then I will close 50% of my position, and then I move my stop loss, which I probably will be down here somewhere, down to break even, and then I wait. Because as a good trader, I would expect these to consolidate and go up on a normal world. Unfortunately, recently with Greece development and how the story is going in Europe, it's been a bit out of the normal. It's a bit behaving a bit strange. But yes, on a normal retractment pattern, you would do this sort of trading. Now, if the price goes and flirts a little bit with the 50% line, then you would I would stay out personally. You would probably be looking to sell again, because you would sell in every level if you are one of them traders that wants to go and sort of go against the trend that is forming. But you don't know if a trend is forming, and you don't know if this price could penetrate further and further up. So, I mean, there is no official rules. There is no there is no really commandment written about Fibonacci retractment. You only use these numbers as a reference. but the trend could easily break all of these levels and go up, and that's it. And then you will be in trouble. But by general rules, if you look at a retractment from a big down push, then you will be looking for these levels, and you will be looking for Fibonacci to help you find them levels, which in this case is 118 and well, one sort of 114 ish. I have seen trends that have gone all the way down to the 61% and then bounce back again following the main trend. I have seen it before. It happened a few times, and yeah, anything can happen in forex. So you just have to go a bit safe and make sure you play by the more common rules rather than try and be defiant. Unless you have a lot of money, then happy day. Okay, so that's for Fibonacci so far. There is a lot of Fibonacci, well, a lot of different Fibonacci drawings and all sort of. I mean, if you use these trading view charts, you can see a lot of them there. Circles, trend-based time frames, spirals. I have no idea how to use. I do like the Fibonacci channel though. I think it's quite good because you just place your line there, and then you sort of put your channel, and then you can have a good idea of what levels. And I mean, I do these sometimes on the other way around actually. Let me delete that one. I didn't work very well. There you go. You do it this way, then that way there, and then you sort of know how far away are you from the 0% time. Not everybody uses it. I don't know if to be honest, I'm not very I don't really use that every single time because yeah, it's one of them things you only do it when you feel a bit artistic. Okay, so that's for Fibonacci. Gann. Now, WD Gann was a stock and commodity trader. That guy, he worked in the 50s, and he made a lot of money. I think he made something like $50 million in the markets, and he made his fortune using this method of he developed this trading instrument based on relationships between price and time. So whatever the price move and how long it takes for the price to move. Yeah, well, I mean, there is no easy explanation for Gann methods, and this is what I'm sort of hesitated a little bit. But in essence, he used angles in charts to determine support and resistance. You would probably find a bit more of information if you go to Google and then Google Gann numbers or Gann fan, which is one of the things I quite like. But just sort of to put it on a very simple, again, a very simple nutshell is, imagine that we are here right now. We don't know what the future is to come. We're down here at the moment, and I'm going to play the Gann fan. Okay, so the way I do it again with this one, within my trend, within the latest trend, I would find the swing high and the swing low, and I was sort of trying to I mean, this is not very accurate probably, but I'm just going to try and put them two together. Why am I doing these? I'm doing the highs with the lowest that we found before. We will probably put it down here, and it will probably give us the same result anyway. But I'm just choosing it here because that button there. So okay, so we then see the price moving, and this is periods of time against the price movement. You got the main one, the 1-to-1 is the center, and then you have 2-to-1 and 1.5. So sorry, half and 2-to-1, 3-to-1, and 1-to-3. You got certain patterns there. You could probably find a lot more information about this one, but I'm just going to show you practically how it works. As the time passes, you would see here. Well, we found the bottom of the channel there. I'm expecting the price to touch the top of the channel here, and if it breaks that, I would expect the channel to use the break as well, that would be first a resistance level, and then I'm going to expect that to be used as a support level if he breaks that. So let's see what happens then. We go all the way, all the way, all the way, and there you go. He's broken. He's just broken the main channel there, the one-to-one channel, and I would be placing my buying position after the second candle. So that candle breaks it pretty much. The second candle, which is this red one here, I will place in my buying position. And where would it be my target? Where my target would be, in principle, then that channel at the top there. Because I think, you know, if he's broken the channel, he's going to use that one. I mean, you probably use this in a different way. I use it this way, and look what you would have done. You know, you would probably have a few scary days there of losing a bit of money, but then you would make some money there. You would probably have a first target, obviously using your levels here anyway, and then your second target, again, like I said before, you would use as well trailing stop or some sort of securing for you to secure the position. You would make a few pips there. And then again, you know, after you found that pattern there, which we're going to be looking at the second video, that engulfing pattern there, you would have sold, because you find another roof there within the another level. It's not been able to reach the 3-to-1 level here, and by quite a big gap there when he did over here this time. So yeah, he's not been able to watch not been able to take it there, so I'm gonna sell. And where's gonna be my take profit? Well, I'm gonna be using this as a support line, and let's see what happens with that support line. There you go. So it respects that support line very well, and then the price bounce again, looking for that line again. Look until it actually touches that line. You would already seen here, just by looking at how this is set up right now, that the up movement here is already exhausted there. He's tried a couple of times. He tried it before in the past, and now he's touched that and he's bounced back down. So on the second candle, I would have sold again on the second candle there. And again, you know, trade the simple rules. You can follow your own rules, but yeah, basic at the moment that I'm explaining is just how entry. So using these sort of indicators, so you would have sold there, and then again you would have made some money until today. So what is expected to come? Look, it used to be price used to be bouncing within the 1-to-1 to the 2-to-1. Now it's bouncing between the 3-to-1. As the price breaks these barriers, you would start thinking that the trend is changing. And this is the thing with Gann numbers. When the price starts to move up across here, and it starts making it starts making that, then you would find as it breaks and it breaks and it breaks, the trend becomes sort of more flat, and then he's showing you an up movement there. He's showing you that the price is exhausted the down movement, and it's starting to jump from step to step, boom, 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 and then you think, oh, wait a minute, you know, this trend is maybe getting to an end. We have to do something. We have to start changing our trading methods, changing our minds, resetting our ways of thinking, and yeah, just again go with the trend. Okay, so that's Gann and Fibonacci numbers. I'm just going to close this one and reopen another chat. I'm not really bothered about having to delete all of that. Okay, so next one that we're going to see is waves, and I know we're gonna talk about waves later on. And I have a whole section for waves later on, and we're gonna see the specific one, my favorite wave. But just on a nutshell, and before we will look at it later on, Elliott wave theories is an approach to the market analysis, and is based on repetitive wave patterns, and is also using the Fibonacci number sequence. So you use Fibonacci to find the wave patterns. obviously the never ideal, but the actual ideal one, and the one we're going to explain later, is a wave pattern that shows a 5 wave in advance followed by 3 decline waves. I'm not sure if I'll be able to find one at the moment. I haven't really prepared these, but let's see if I can find some waves here. And again, remember there is 5 waves of main trend, main impulse, and then you have 1 wave of retractment. Sorry, 3 waves of retractment. ABC. So shall we see if it's one. So there you go. That's 1, 2, 3, 4. No, I've chosen the wrong one. Yeah, I think you can get it already anyway, but yeah, 1, 2, 3, 4, 5. There you go. And that's the impulse. And then you get your retractment wave correction. You get your, well, in this case would be 1, 2, and 3. And yes, my friends, some of you will be saying, oh, wait a minute, it's about time to get started in another wave. No, it doesn't work that way. That is once you identify the 3 first waves, and it's usually the third one is the biggest one, which will probably be a bit, maybe a bit too late, or you maybe will be a bit tired of waiting. You will probably anticipate it, but you look at it with time, and obviously there are mini waves inside these massive waves. These are very clear because it's on a daily chart, but yes, that doesn't mean that the next wave would be exactly the same as this one, which if we clone this one, I think some people will probably be right now crying of happiness if they see me doing this. So yeah, if you say, you know what, we're going to start another waves exactly the same that we did before, well, this would take us to a catastrophe, really. 0.79 euros per dollar would probably be probably be the end of euro as a monetary union if we do that. Yeah, we'll probably survive. He will go adapting bit by bit, but at the moment, I don't think that's a very plausible scenario. Again, probably up here at 140, you didn't thought 1.5 wasn't a very plausible scenario. So anything can happen, but you have to think as well how macroeconomic indicators affect the price, and what big banks want from and institutions as well, and the central banks what they want from the currency. So yes, I mean, when you look at it that way, you will probably find contradictory things to waves. But yeah, I mean, in a nutshell, that's how it works. 5 waves down, 3 retractments, and then either 5 wave up or 5 waves down again. It works that way. You probably have a consolidation time as well, where you can't really find any waves, but once you find them, boom, there you go. That's your trades done. And the good thing of waves and finding harmonic waves and Elliott theory is that if you can find the first 2 when the third one starts, look, you have probably 1, 2, 3, 4, 5, 6, 7 or 8 trades there already done in front of you, and you would make a lot of money with them trades. So yes, that's how waves work. We'll look at it later anyway. We'll look at actually what levels you need for that. And finally, well, gaps and trends. So I think the video is getting a bit too long. 1 hour and 14 already. I'm sorry about that. Gaps and trends. So I mean, gaps, pretty easy, is when the market is not open, it is closed, it's not open for trade, but the price have moved, usually because of macroeconomic event of something that really big happens. And we have two beautiful examples this last week with the latest development of Greece. If you are watching these in the future, yes, Greece has voted recently against the creditors' proposals, and there's been a bit of a shake-up in the markets. Not as much as some people would like, but enough to make some big wigs worry about the situation. In a nutshell, this is gaps. This is a gap. That's how it's represented, and this is another gap. There's three types of gaps really. There is gaps for continuation. There is rupture gaps, which they're quite strong, and there is just random gaps. Most of them they're all continuation, which is good, but some of them are actually rupture. And again, we can put a beautiful example what's happened with Greece recently and the euro dollar. If we go back to our daily chart and we zoom in here, we can see the gap there. That was the gap the previous week. We can barely see the gap really there, but we can see it quite pretty there. So if we were to place a channel here, which I'm going to do with these, for example, and I'm just going to bear me a second, this is a bit too short with the channel. That needs to go in this one. Where is that candle? Here we go there. So yeah, you want to just put these 3 points together really. That gap has broken the channel up, which is it could be used as a very strong signal for going short and selling. We have to wait for confirmation though. The next couple of days has to stay below this line and use this line as a resistance rather than as a support, like it's done it 1, 2, 3, 4 times, 4 or 5 times before. It's used that line as a support, and now it should use the line as a resistance. If it does that, first level to look at in this situation, in this occasion, would be that level there, which is the more recent 2 lows. And if you break that down, then hello, we're coming back down again, so we will think about selling. That's how you use gaps for trends. So much to talk about trends, but basically a trend is formed when you have lower lows and higher lows, or higher highs and higher lows. So in this case here, as we can see, again back to our daily euro dollar, we have every time it makes a low, it's lower than the previous one. It's lower and lower, and lower and lower and lower. But as well as that, every time that does a high, is also lower than the previous low. And then when that happens, the market is trending down. When the market does the opposite, when the market trends up, it always makes higher highs and higher lows. So that won't be used there, but you can use that one. I would sort of count this one as a part of the major trend. There you go, high highs, and then this is a beautiful example, high highs and higher lows. Again, it was broken there, but within the main trend, it's still making higher lows, and higher highs. So, well, actually, this is the first time he's not been able to make a high high. So yeah, we might think that the trend is changing there again. But yeah, on a very simplistic nutshell, that's how it works. You get higher lows and higher highs, or lower lows and lower highs when it's trending down. Okay, so moving on to fundamental analysis, and I'm going to pretty much whiz through the next 2 slides because this video is already too long. and I know you want to go to the toilet or get yourself a drink, or probably have paused the video already to do get some water. Um, but yes, fundamental analysis is another way to look at the market. Is another way to it's basically an analysis method. Uh, is a method of forecasting the future price movement, but instead of on the charts only, on the price only, and based on financial instruments, based on the economic, political, environmental, and all the relevant factors. You have so many different factors that would influence the price. What happens is, depending on the impact of these factors, your the price will move more or less. And this is something that you can see quite well in here. So if we put our screen, so again, you can see it here. You can see the impacts. So you have green, orange, and red. So higher impact are these red ones, and they usually you have to look for countries that you would they would it's relevant to what you're trading. If you're trading euro dollar, it might doesn't matter if Zimbabwe decides to uh, uh, up at the interest rates, because that doesn't affect that much. So you will look at countries and institutions within that either use your currencies for you to be able to use that fundamental analysis. This is how fundamental forecasting, well, like a calendar looks like. So you have a period of times, which is what the new is coming from, which is this one is publishing June's job advertisements. Usually, some of them are quarterly, some of them are monthly, some of them are weekly, a lot less. You also have a prior figure and an actual figure, and the actual figure gets filled up as the news get published. And you have a survey. Now, this is quite controversial because surveys are based on previous calculations of previous years and previous times, where it might have nothing to do with the actual period of time for a PMI service for the USA, or I don't know, or NFP, non-farm payrolls. They might have nothing to do. They only look at the previous years and average how much it moved, what do they think is going to be on, so they come into a consensus and they say, right, okay, we think this is what the indicator is going to come out. And if he's obviously if he's higher or better for that determined news, then it's good for that currency, and if it's worse, it's bad for the currency. The only thing with these one, and I think I find confusing with these one, is that some numbers, if they are lower than the survey, they are also good. For example, unemployment numbers. The lower the unemployment rate, obviously, the better that the country outcome is, the better that the economy in that country is going to be, which makes that the currency for that country go higher. And that's what you need to look. You can look into these things just by clicking on them. Let's go back to our website, and I'm just going to show you an example. Oh, this is not the one. There you go. So this is an example of today's. And as you can see, well, you have the majority of this one. Yes, I'm using WVP online. You can use it as well. They don't pay me, but yeah, I'm using it because I quite like this one. So yeah, you get the new released, and then you get the figure, and then the figure they will usually color it with fancy colors, and they show you green is good, red is bad. Okay, it might not be as bad, but it's lower than expected, so it's still bad. And usually all of these calendars, if you click on it, you can see an explanation, and you can see historic outcome of the same indicator, of the same numbers within the past couple of years. And then some of them do a fancy graphic, and you can move things, and you can see. I like to read that and this, and then just see how it comes out. Now, trading news is very, very tricky, and some I would advise you, if you're a small trader and you haven't got much equity and you can't take surprises, or if your heart has taken a few beats before, um, avoid trading within news. You can look into here and say, okay, well, I'm going to trade in between these times here, or I'm going to trade after the major news has passed, and then I start trading today from 3 p.m. From 3 p.m. After 3 p.m. I start doing my trading. Look, there's nothing else after that. So yeah, it depends how you are as a trader. It depends whether you want to use more or less. I like to trade news. I think they're quite fun because the price moves very, very high, and I'm going to show you a very good example of where the price moves. And I'm going to show you a very good example with the non-farm payrolls. And I'm going to use this latest one. Oh, again, I'm going to use this latest one that we had last month. Sorry, to actually show you what I mean by trading the news. So I'm going to go to the 1 hour chart, and we're going to go back in time. Yeah, we got that machine, which is quite good in the trading industry. There you go. So that's the 5th of June. You can see it down there. That says the 5th of June. There you go, 5th of June 2015, 7, no, that one, 8 o'clock, obviously that time is depending on that discharge, GMT alignment, but yeah, we're going to look at these massive candle, and we're going to see that in our calendar, see how that looks like. So if we go back in here to July, June the 5th, and then we apply that changes. Okay, we're on Friday, June the 5th. We have, there you go, 1:30 p.m. London time, because this is where I trade on. Change in non-farm payrolls. That came out really good, even though later on it's been revised, which is another very naughty thing they do. So yeah, the prior one, so there was 223k non-farm payrolls being issued, which means that there's 223,000 working in non-farm roles, basically. We were only expecting an increase of 3,000 that day, and look, it came out a really good outcome. 280,000 roles. That's a lot more than what we expected at all. And the previous one to this one, and they usually do these on the following when the following indicator comes out the following month, they always revise the previous one if it has to be revised, because remember, they get this data that day, but then they analyze the data in the coming days, and that might changes and might doesn't actually look as good. So the previous one was 2023, and that was actually revised to 221, which makes this gap a lot bigger, which makes this new a lot better. And at 1:30 p.m. London time, the euro dollar plummeted, and it plummeted, as you can see here, all the way from 112.29 down to 110.54. Yes, we made some money because we looked at the news as soon as this got published, and that showed up like that. I went to my broker and I said, oh my god, sell, and I want to buy dollars because them news are good for dollars. These news is regarding the USA, which means that the dollar gets appreciated with that amazing news. Later on in time, though, that's June the 5th, there you go. Later on in time, you can see that the prior of 280k that was so good was actually revised to 254. Yes, it's still over the survey anyway, the previous survey. But that's still revised down. And then the new one, the actual one, came down slightly below the previous one, but with not much of a difference here. So we're back down again to a normal sort of rate of expansion for non-farm roles in the USA. So yes, that's how fundamental works out, and that's how you would trade fundamentals on a very, again, like I've been saying all this video, on a very big nutshell. Okay, so that's fundamentals. Let's look at sentiment analysis, and this is a bit tricky to get, because probably to get it to fully understand sentiment, you would probably need to be subscribed to every single broker, and you would probably have to be using a lot of social networking and have a lot of friends that they do trade. And this is one of the reasons why we do what we do in our forum, because it's a very good way to capture sentiment from other traders that do exactly the same that you do, and we all feel that something is coming on, something is too expensive, something is too cheap, and we all trade in regard to that. So yes, it says there, kidding aside, the market is basically represents what all traders feel about the market. Each trader's thoughts and opinions, which are expressed through whatever position they take, whether they sell or buy. This is an example of Forex, although I'm going to tell you, I'm going to put you a website later which is quite good, that shows you a few of these together, and you can probably find that. The website is called Market 24-hour clock or something like that. There you go, here, market24hourclock.com. And this website, you've got obviously all the time frames up there. You've got this nice fancy clock, and if you scroll down, you can see this comes from different traders, from different brokers. That's all Parry. That's Duca's copy. You can see down here Forex. You can see investing.com. He's quite good for that reason, because he's put a lot of them together. And you know, if they're all saying the same to you, if more people are selling than buying, 51, 47, in that case it's not. I would say if they're all aligned together, why would you go against them? You know, if sentiment goes with you, then why would you go against? Now, this is the first video finished already. I know, thank you. Thank God for that. And I'm gonna have to say thank you for watching. I'm gonna make the next video probably in the next day or so. What I want you to get out of this video, with the view of using the three legs there, when all of the three legs align and tell you something like buy or sell, do it. If the three legs are not being aligned and you don't want to you want to minimize your risk of losing money, then why are you going to risk it? So I would say 33.3% of your risk is gonna be these three legs there. The more things that you can find pointing at the same direction, the more chances that your trade will be successful. And that, for me, is the first part of the video done. I accept Q&A. They're disabled in the YouTube channel, but you can come to our website, to the candlesticktrade.com, register there and ask me whatever you want. You can also ask me through my Twitter, SolidSnakeUK89. I do like to tweet a few things there, what I'm doing. You can add me if you want, or send me a private message. I'm more than happy to help you. Please find those websites there. They're quite useful. Have them all. Read through Baby Pips. I couldn't have not done these without Baby Pips. So please read through Baby Pips. Do the whole school. And until you complete these, you can forget about trading. Don't trade unless you've done all of that. I'm doing it again, as you can see. I've done it 5 times now, and I keep doing it one and again because I love it. So yeah, go again through these, through the school. Don't be silly. Get into it, and I'll see you soon if I can. Thank you very much. Bye bye.